Interest rates, apartment supply, and sentiment is at the top of the agenda for the Gray Report this morning, June 12th. We had a CPI report that came out at 8:30 this morning showing CPI essentially unchanged. Good data for the Federal Reserve that's looking like they can confirm that soft landing that we thought was almost impossible just a couple of years ago. But more from the apartment industry. Apartment List has an article about, what will the pullback in the multifamily supply look like? We have had discussions about a huge fall off in the end of 2025 and 2026 in terms of new multifamily deliveries. Is that really the case? It may not be as dramatic as you might be hoping for, but also getting into the sentiment of the commercial real estate market. A piece from Cushman & Wakefield looking at the U.S. macro outlook. It's an uncomfortable soft landing, and again, are the outlooks of sellers, are their perceptions of where their prices, have they changed? Is that bid-ask spread narrowing, and have those backs been broken? We're going to get into it. And for Marcus and Millichap, the perceptions of the CRE investment market. Again, we're getting into the psychology of multifamily investors and commercial real estate investors and participants. And then lastly, from Fannie Mae, home buying sentiment hits a new survey low. Not surprising with these high interest rates. What does it all mean for you as an investor or someone in the apartment industry? We're going to get into it. Strap in. We've got a great episode. Make sure you've liked and subscribed this video in the Gray Capital YouTube channel. Let's get into it. Welcome back to the report. Incredible, exciting day. A lot of news, a lot of data, and it's moving around. Not all of it is even broken yet, Matt. We may have to do an update later today, depending on the press conference later this afternoon with Jerome Powell. But we've got CPI, and this is an incredibly important report, Matt, Consumer Price Index, because again, this is moving, the psyches and the narratives around where inflation is and where interest rates may go, and when. Really when, not if, but when the Federal Reserve may begin to cut rates. We're just on the backs of the European Central Bank and the Canadian Central Bank cutting their benchmark interest rates, Matt, last week. It's a big global sign that says, look, central bankers are looking at easing, still in restrictive territory, but coming off a little bit, again, to maybe achieve this perfect soft landing if there ever could be one. Yeah. But we're also, again, living in a world, Matt, where every 3 or 4 weeks, sentiment changes, and we go from no rate hikes this year, absolutely none, impossible. Interest rates are going to run, to interest rates are falling off a cliff. The 10-year is down closer to 4.3, 4.27. It's been going from there to 4.4, back and forth, back and forth. The 2-year yield is now below 5%, which is a big deal. So things are moving. I think this is a big deal. With more information from Jerome Powell and the FOMC later today. Matt, what were your first reactions when you started digging into some of the numbers and some of the detail? Because I think I heard it, but just I'm give your reaction.
I think it's pretty promising. I think that there are plenty of reasons to be confident in these numbers, and it's something that we've been waiting for a long time, and something that we've really thought was predetermined and was going to happen, 4 or 5 months ago. But these numbers are coming down, and I don't think that's going to matter to anyone's thought of the economy. The sentiment on the economy is still going to be fairly low, but at least we have this, and hopefully it will factor into the Federal Reserve's opinions. I think that no matter how you slice it, 0% increase is good. But this is true in other reports that we've read when it comes to sentiment and perceptions, especially when it comes to inflation. People don't want lower price growth. They want the prices to go down, and that's just a sad fact.
Yeah, and probably just not going to happen, at least across the board. Yeah. I'm looking at this graph, Matt, of CPI, all items going back to 2004. I mean, obviously we had this huge run up, after the pandemic. Inflation basically, peaking out right or just under 10%. But now we've been kind of stalled here since really kind of July 2023, kind of throughout the last year or so. Yeah. As we've been hovering around this kind of 3% range. But we have, I guess, the progress is that, we're not seeing any more growth, and we're kind of, again, hovering in this 3% range, which is well above the Fed's target of 2%. But when we start, I guess, acknowledging that this data isn't perfect and this isn't exactly where inflation is today, this is really just the number, the components of CPI. And especially when we get into the details of shelter, Matt, while the shelter has come off the growth of that we saw. I mean, it's not growing at the 8% that it was saying that it was growing in April of 2023. It still shows shelter generally growing by 5% when we had an entire year, Matt, where the nation's rent growth was negative.
Yeah. Well, and the decline in shelter prices is slightly less steep than the growth in shelter prices. I think that it jives, or however you put it. It really resonates with these articles that I've been reading lately, where it's like housing may be permanently more expensive than we thought, and it may not come back to normal. This shelter price growth, or shelter prices, that is, may not decrease. That it may just stop growing.
I mean, if you look at some other developed countries, whether that's the UK or Canada or Australia, I mean, their housing prices are significantly higher than the United States. So it's different from what we're accustomed to in the U.S., but it's really not outside of the norms of kind of where the rest of the world is.
Yeah. That being said, I mean, we are going to talk about home buying sentiment, and that's low, and that should lead to a little bit lower home prices in theory.
Yeah.
But that being said, people have been thinking that it's a horrible time to buy a home for the past 2 years. And for the past 2 years, home prices have continued to go up, even as rents have gone down. I think that that's a story that a lot of people, and maybe they are, but they're not talking about it enough, in my opinion, is how much home prices have been resilient and how much rents have gone down comparatively.
Yeah.
And like in the face of inflation.
And now, when we look at absorption in rental units, while like rent has come down a little bit, with all the new supply that's been coming online, which we're going to get into in just a second, we were anticipating that we would see further declines in rent.
Yeah.
I mean, further increases in vacancy, declines in occupancy. But the fact that, we're keeping our head above water, I think is the best way to describe it.
Yeah.
I think underlines, okay, there's actually quite a bit of demand for the rental market. And some of that, not all, some of that is being fueled by it's difficult to buy a house.
So there's like interesting data that it's not there for apartments, but for single family rentals, they have information on like what proportion of people are leaving a single family rental to go to buy a home. And they don't have that for apartments again, but it would be really interesting to know, okay, are you renting an apartment because the home buying prices are too big? Are you leaving an apartment to buy a home or to rent another apartment? Those kind of numbers would be interesting. Maybe put it on a leasing form or something, or just a little questionnaire would be great to know, just for my benefit.
Yeah, and in that makeup of renters by, we used to call them renters by necessity and renters by choice. I haven't heard that term used as much recently for whatever reason, but I think that's shifted because not that people are making less money. It's because all of a sudden people who could have afforded a house but were choosing to rent, all of a sudden, who would be the renters by choice, they're still doing really well, but it may not exactly be as much of a choice as that label, would describe.
Yeah, I agree.
Matt, just looking at some of these other metrics, then let's move into the apartment market and looking at supply, because I think that's just really interesting. Looking at taking off shelter, looking at just food from home, Matt. Look at, we've seen again. This was a big complaint recently. So I think I don't think it was just eggs.
I know, but that's what people always say, eggs. And it's
eggs
like,
were one thing.
That was in 2022 and 2023. Maybe it hasn't been eggs for about a year. So I heard that specifically 2 weeks ago. I was like, oh, I wonder where you buy your eggs, because you're wrong. It's other foods.
They're going down to the farmer's market, Matt.
Yeah, I guess so.
But anyway, so food inflation, food at home was up 13.5%. That was incredible. And that's what I think really was putting a lot of pressure on people and being like, I can't make a big decision. I can't afford food.
Yep.
Well, that's really now declined. Wages are, mean, wages are outpacing inflation right now, marginally, but I mean, wages are significantly outpacing, the growth in the food at home costs. Not exactly sure on what's driving all of that, but it's definitely good for the economy and for the consumers. Energy, Matt, also down a little bit, and so we're seeing a lot of these energy's down. Now it's up a little bit. We're seeing a lot of these components. Food generally is the similar. Food away from home,
Even
down.
food away from home's going down, and that's a $50 Big Mac, which I'll reference again.
Yeah, gasoline, which is obviously this is just what the oil markets are doing more or less. But new vehicles, I mean, look at that, Matt. New vehicles are way down. The service is less energy. Medical care services, that's more of an insurance conversation right there. But generally, Matt, we're seeing some progress. I think that the Federal Reserve is definitely going to want to see more data. A lot of calls and conversations about a September cut to interest rates, most likely 25 basis points. The other central banks just did 25 basis points of cuts. I could my base case is still for a very early 2025 rate cut. I think they're going to see it through just to make sure, because I think if they announce rate cuts today, the markets are going to go crazy, and they could kickstart inflation once again, and we know that they don't want that.
I believe that they are also releasing their economic projections today as well, or at least this week.
They are. The survey of economic projections.
It'll be really interesting to see what
it will be. And again, not getting too inside baseball or really trying to get into the psychology of all of it, but I see, again, there's a lot of conversation around they're going to lower interest rates right before the election. And I'm in the camp of they're not going to do that because of the election, for the main reason of they're so concerned with the Federal Reserve's image and how they're perceived. And I think that a lot of our institutions in the country are trying to save face and trying to regain credibility. After a lot of losing a lot of credibility over the last couple of years, and I may be at a place for saying this, but when I see, and again, not getting into politics at all, but when I see the guilty verdicts at Trump's trial a couple weeks ago, regardless of what you think about that, kind of crazy charges, but regardless, guilty verdict. Okay, former president, he can be found guilty. And then Hunter Biden this week being found guilty on those 3 gun charges. Both cases where the charges were like, if they weren't that person, they probably wouldn't have been, charges were brought against them. That's either, that doesn't matter. The fact is that there are people in power that are being held accountable. I'm not saying, again, don't agree with necessarily any of this. I'm just saying the perception is being put out there. Our system works. The justice system works. We can put a former president, we can convict a former president. We can convict a current president's son, all trying to regain some credibility, our major institutions in the United States. I'm not saying they deserve any credibility. I'm just saying that's what they're trying to do.
Yeah.
And
whether you agree or disagree with either of those, it is a little bit of a flashpoint right now, and it has raised the idea of credibility in whether it's the justice system or or all these different institutions, I think. And I bet that the Fed is thinking, well, if I lower rates and then
in September, right before the election.
Yeah, right before the election, and then Biden loses, then am I going to face retribution? Because
or if he wins, they're going to say the Federal Reserve is being is just a tool of the Democratic Party or something. And I don't think it's there's a big conspiracy, and there's a room where the Justice Department and the Fed are getting together and we need to regain credibility. But I just think that they're independently coming to these conclusions of look, what do we have to do for our credibility so we can be an effective institution? They're coming to similar conclusions. And whether it's subconscious or not, and again, at these institutions, they're not going to say we need to make a decision to regain credibility. Because like that's the opposite, really.
Yeah, and it does have a direct, especially for the Federal, if not anyone, it does have a direct impact on how they are able to communicate their message. And are they if no one perceives them as credible, they're not going to take them as seriously when they're trying to communicate and they're trying to change people's minds about their consumption.
Yeah. So again, this is just kind of conspiracy corner, and it's interesting to think about. But again, so my base case is not for September, but it's going to be more January for that rate cut.
Okay.
But but with this data, I think that it's very reasonable for a rate cut to take place in September.
Yeah.
Again, not because it's like everything is fine and we're out of the woods, but at some point, we're looking for a more variable, like slowdown and easing rather than a huge downshift, because we don't want like there to fall into a massive recession and then have to bring rates down to zero again.
Yep.
I mean, would that work? Like, sure, but the whole idea of a soft landing is you're gradually ease it. It's soft.
Yeah.
So you have to start easing off the. You got to put the flaps down.
Yeah.
And you've got to ease off the.
Yeah. No, it's true.
Throttle.
I just want to go over the numbers just really quick, just to give people an idea. I think that especially though the shelter change, the fact that they didn't change is particularly notable, and it has been 0.4 for both of those for the past like 3 or 4 months, and that's in terms of monthly increases. We'll see how that pans out. It does seem particularly stubborn, and I especially don't know why rent of primary residence has been so sticky and has these increases been not moving at all, when on the other side we're seeing market rate apartments rents are, as apartment list measures them, rent growth, year-over-year rent growth has been negative for a full year.
So at what point will those numbers start seeping in?
Yeah.
No. All right. So Matt, let's move on to the next story. What will the pullback in multifamily construction permitting mean for the rental market? And in this headline, I don't think does a great job of actually talking about the core findings of the article, because they're saying, well, what's going to happen? They're saying that there is a pullback in permitting, and that's true.
Yeah.
I think the headline should be closer to like pullback in permitting and new multifamily construction, not as deep as you think it is. Because, and I think that we've been victims of this, or not even victims. Maybe we're the maybe we're the perpetrators, Matt, of saying there's going to be a big fall off in construction, because there is going to be a big fall off relative to what we're building today, and permits are certainly declining. But again, we have these base effects of like they're declining from the peak, and so today we're building. There's 1 million units of multifamily under construction right now, and with maybe almost 500,000 of those being delivered this year. We're kind of at the peak delivery time, like right now. More units than have like ever been permitted on record, and we're at 40 to 50 year high in deliveries right now. More supply than ever. And the narrative has been, okay, well, that's a lot of supply. We have to get through that. But then in 2020 and 2025, early 2026, because interest rates have come up so much, builders have really kind of turned off their pipelines because the financing doesn't make sense. That makes a ton of that tracks. Because it's hard to get the financing, the equity's not there. How are these deals penciling? But then looking at this apartment list report, Matt, it doesn't really look like we're going to see like a real fall off, but really more just returning to pre-pandemic levels. They're coming into balance, but for there to kind of ease off and give us the headroom to absorb this new supply, which it is being absorbed, fortunately, because we're seeing a lot of demand for a handful of reasons. It's not like we're. I mean, look at the fall off after 2009. I mean, went to basically truly no supply. These are permits. In 2009, there were 141,000 multifamily permits issued. I mean, that eventually grew to let's call it the pre-pandemic peak in 2019 to 524 units. That was the pre-pandemic peak. And so now in 2024, these are permits for future projects that not all are eventually delivered, but a lot, not all. And that's a conversation that we've had with the folks at Carl Whitaker, at RealPage, and others. But in 2024, we've got 525,000 units permitted. Again, basically the same as 2019, and that was the previous cycle peak. Now, it's true, in 2022, we permitted 700,000. That was insane and only could have been possible because of 0% interest rates.
Yeah.
And so while it's nice to get a little bit of a reprieve, I mean, but this isn't really the break I think some were hoping for. Now, the argument, though, that again the folks like over at RealPage would have been making, which is in contrast to the argument or the data that our environmentalist is showing, and also data that Yardi Matrix is showing, is that it's the opinion of RealPage, if I can paraphrase and apologize if I get it wrong, is that a lot of times these permits don't translate to actual deliveries.
Yeah, and and I try to do some of that math too.
Yeah.
And it could be like 20 or 30% of these permits don't turn into deliveries. We're never going to see a year that has 700,000 apartments delivered. And that's, I don't think it's necessarily because of delays kind of shifting that whole 700,000 over a period of many years. I think it's more like for whatever reason, maybe you had a environmental remediation that you learned you had to do. Maybe a traffic study didn't go your way, or some other regulation or anything that starts after the permitting phase, then you abandon the project. Not the least of which is, oh, wow, interest rates have risen so much. I need to get a whole lot more funding for the next phase of this project. I think there's a lot of salient reasons that could motivate this drop off, especially in the wake of the interest rates. Not the least of which is like this typical drop off, which could be 20% of these projects don't.
Well, that would, I think, be welcome to the industry, and I think there will be some. It's just how much actually ends up getting dropped off. And looking at the actual kind of deliveries, you can see how big of a spike. It doesn't fit on the page, but the total units completed from the 90s to 2024. You can see. That's just an incredible spike in 2024. 588,000 units anticipated to being delivered. That's compared to last year when we delivered 450, which was the previous high.
Yeah.
Prior to that, again, we were in the 300,000 range. This was all fine. I remember.
Now the 2024 numbers are a little bit of a projection based on but it's still it's not an outlandish projection, and it does reflect that 700,000. Maybe lop 20 or so % off of that, and there you go. They did do a timing here, and they said that the time between starts and completions is now calculated at about 17 months. Now, the latest data that they had is from 2022. So they say it's about 17 months from start, and then you add 3 months of that if you want from the permitting to the start. So all in all, from permit to completion, about 20 months now is the average time. I have some words to say about that too.
Oh, okay. What's the word?
I don't know if they are counting each building as the same for an average, or if they're weighting it by number of units, because I'd like to think that a 300-unit building takes a whole lot longer to build than a 5-unit building. I'm sure they're weighting it by units, right? Well, who knows? But in that case,
it doesn't. It doesn't.
Yeah, I think that.
Can it be? Yeah, but like, if you're a single one house, you're going to build it in a year to 18 months.
I know. That's why I think
it's more the pre-construction, get everything on site, and then you have the crews. If you've got the framing crew, the framing time is going to take a similar amount of time. You just have a larger crew.
Yeah. Okay.
More people. And should it take longer? Like,
I thought it was 2 years.
A little bit less.
I was surprised that it was 20 months even. Really, I thought it was 2 years.
It can
plus.
be. I think that there's. It is. I think 2 years is safe.
Yeah. Okay.
And people, you can say, could be up to 3 years. But then also the bigger question is, do you include, and they mentioned this in the article, is that you can get certificate occupancies on some of the buildings. Like, you don't deliver the whole. Typically, you're not delivering the whole building at once.
Yeah.
And you're delivering one. Or the whole property at once. You're delivering one building at a time, getting a certificate of occupancy on it, and hopefully you're leasing that building up in relatively short order. And so, and is it completed when the construction stops, when you get the certificate of occupancy? But then also the next question is, how long does it take to lease the property up?
Yeah.
Because you're really not done with the project I mean, you're kind of never done.
Well,
with
its
it, but you
impact
sell
on the
it.
market is not really felt until it's all leased up.
Yeah. Well, the full impact, it starts impacting the market as soon as they start leasing that first unit, because you can see all of a sudden that you drop, whether the first building's got 50 new units, you're adding 50 new units of supply that are all trying to get leased up, and brand new units, and so it can will have effect of obviously lowering the average occupancy in the market, and depending on where their rents are, it can move rents up or down depending on those rent levels.
Yeah, I have reached out to some people from the census just to get some clarification on how they're measuring those completions. But either way, I really liked this report from Chris Salviati, and it's worth digging into. Not the least of which was how they opened it. I just want to, just as a kind of final note, they say, following a period of record-setting rent growth, the national median rent has since dipped slightly from its late 2022 peak. I did a double take. I was like, wait, rent growth? Rent growth has fallen off a cliff. But no, the actual rents have dipped slightly. So we are now $50 below what rents were in late 2022, which means we're trending down ever so slowly from that peak rent. And this is an audience issue. The audience of these apartment lists are not merely multifamily professionals and owners, operators, investors, whatever. Some renters are probably reading this too and thinking, it means a whole lot to me that I'm not paying any more and that I'm paying slightly less rent, and that's what they're waiting for. So it is actually happening here as Apartment List records it.
Yeah. So take that, Federal Reserve.
That's right.
Or Jerome Powell, are you listening? How much the Board of Governors listens and watch the report, Matt? Can't give you the exact number. But if you'd like to get the same information they're looking at, make sure you subscribe to Breakout, the YouTube channel, and give us a comment and tell us we're on point or not.
Especially if you are a member of the Federal Reserve.
Yeah. Check in. Ring the bell icon.
That's good.
Okay, Matt, let's move on to this. Well, if it pleases you, let's move on to this Cushman and Wakefield piece. We're talking more about feelings.
We're
less data, but feelings are the impetus to some data, and they are data themselves. But
and I think this is. This communicates what we talked about at the outset. This has been a little bit uncomfortable, a little bit maybe an understatement if you're measuring economic sentiment, which is just bewilderingly low right now. It is uncomfortable. This push-pull between interest rates, job growth, and inflation. Our jobs report that was a week or two ago, that was a little higher than people thought, but unemployment actually, if I do recollect, it ticked up a little bit. So there are some mixed feelings there, and just the chatter that I'm hearing on
chit chat,
on the comment sections of the internet, it's all
good
dismal.
Place for information.
Yeah, I know. That's the heartbeat of society, right? But they're all down in the dumps. There's no one saying that, oh man, it's a great job market. Even it's not a dominant frame of mind, and we can wring our hands about it, but I'm not even it's hard to combat this. I don't even think it is it may be a new paradigm in the way that people are receiving this information.
I think the only thing that's going to change that is, as crazy as it sounds, is if they announce interest rates are going to come down.
I wonder that too. I wonder how much is it this. I think we did talk about this too. How much are interest rates? They're not inflationary because they're meant to combat inflation, but they are making things more expensive for people, and that's being felt by them, and it's being interpreted maybe as economic hardship.
Yeah, I think that's a really good point that other economists have made, in that the cost to borrow is going up really isn't fully taken into account in CPI. But if you're buying a car with a loan, most people do. I mean, that cost right there is significantly higher.
Yeah.
If you're putting anything on a credit card or using any type of financing, which we know consumers love debt and are. I mean, that's weighing on more than just where we're seeing inflation at the CPI level.
Yeah,
so that is a good point.
And it may be working in the CRE world, because as Cushman Wakefield put it, this sentiment, this feeling that interest rates are going to remain uncomfortably high for the near to medium term, this higher for longer, this is permeating the market, leading to more price discovery and more optimism around activity moving forward. So it's like a discomfort with a little bit of hope. It's like a nuanced sentiment. And Cushman and Wakefield expect a Fed pivot this fall due to slowing growth and a break in shelter inflation's stickiness. Now, this is this was written before the CPI came out, so it was a little bit prescient. And got to give a hat tip to the authors of this. And I have reached out to Rebecca Rocky, who's an author, and let's see if she can be a guest on the show and explain a little bit. But regardless, this micro outlook, and there's also a fuller report talks about these different sectors and how things are being impacted. Industrial and multifamily are facing supply, but they're going to meet it. That was another thing. There's confidence in the industrial sector, and in the multifamily world, it looks like vacancy may peak this year, which means that it's only downhill from here.
Again, makes a lot of sense. We're delivering all those units.
Yeah.
I mean, that a lot of new supply coming on the market. That is exactly what one would expect to take place. So I think it makes a lot of sense. The Cushman, they've got this really interesting outlook. This presentation, kind of hard.
Yeah,
to
you can
navigate.
flip around. There's some videos there that offer little summations on different sections. I think that the upshot really is, things are bumpier economically. They even said there a rolling recession has begun, but there is nothing in there that would suggest that it's really a bad time to buy. I think that we can kind of get in this when it comes to the Marcus and Millichap section, but what really seems like is that owners are beginning to realize something they perhaps should have realized a year and a half ago.
Well, it wasn't in their interest. I mean, they had and we talked about this. And you're right, but it just there's no incentive to no incentive to be like, you know what. Yeah, I don't have to admit that my property is worth less, but why don't I just admit my property is worth less? Yeah,
and there are increasing pressures for banks. So this was part of, and it may be part of actually the Marcus and Millichap video, and we can go to that if you'd like. He notes that there are some banks that are kind of tightening the screws, so to speak, and there may be less workouts or extensions than one might assume. I really still subscribe to the power of extend and pretend, and I'm not really sure why. I'm not really sure why that can't be true, especially since the federal guidance that was issued. That's like, hey,
it's just how long can you extend for? You go ahead, Matt.
Yeah, but now they are worried. Regulators are worried about having too much CRE on the balance sheet, and that's
I think there's absolutely that, which I think has been a worry for a little bit. But also, I think that some of these lenders have investors. A lot of these loans are syndicated. And a lot of these bondholders or their investors are like, "What are you going to do?
Yeah.
We need to make sure we're getting paid."
Oh,
and they're starting to put pressure on some of these banks to be like, if you guys have to start foreclosing on some of these, we want to make sure we get our principal back and we're getting, we want money coming in. So I think that there's pressure that's gone beyond these are good relationships and they just need a little bit more time. I think people are getting a little impatient. If you're just kind of waiting and waiting and waiting, and we're like, all right, how many times are we going to come back to the table and say, oh, we'll just give it another couple months? Forever? I mean, if you're making your mortgage payment, then I think there's an argument of saying keep kicking it down the road. But if it's close, and borrowers aren't going to want to have to dig into their pockets forever to pay mortgage. Property's not covering. Some can, but it's
interesting, and it may mean, just like we did say last year around this time of year, in our report on loan maturities in the multifamily industry, is that we'll see things bubbling up, and maybe the bubbles may be a lot more frequent now. The the pressure has continued to kind of build. I'm still thinking that extended pretend has this kind of talismanic magical power or something, but who knows?
I don't disagree. You know, CRE Daily had a piece looking at the Tides equity portfolio and examining their properties and which ones, how many looking at rent growth and occupancy growth, and like 40% of the properties have had negative occupancy and rent growth, and only like 8% had positive for both.
Yeah.
And generally though, it's just kind of a bellwether for the Sun Belt a little bit. I mean, they're mostly I think in Phoenix and in Texas, but looking at it's like, how long can you guys extend and pretend if you're telling lenders like, hey, operationally we're moving in the right direction. But then 12 months go by, and it's like, are you?
Yeah.
And if
well,
you're
that's what I
not-
wondered. Is that data ever available? How could we take a postmortem on a company and be like, all right, so how long were they extending certain, some of their loans?
Yeah.
How many of these properties were under extensions or special servicing or something? It'd be super interesting if we had like a thermometer that's like, all right, if it reaches here, banks are at their limit. They have extended enough.
Yeah.
But I haven't found that yet. I'll have to look. Maybe TREP has that on their website.
Well, maybe it's CRE analyst. Anyway, let's look at this Marcus and Millichap piece. This video from our good friend John.
Hey everyone.
John Chang.
As I've mentioned in previous videos, the perception of the commercial real estate investment market varies substantially between institutional investors and private investors. I think one of the factors driving this difference is tied to the risk tolerance of the two investor types. In general, a majority of the institutions are still on the sidelines waiting for another shoe to drop.
Makes sense, I guess.
Many of them believe a wave of distress is still coming and that prices will fall by another 5% or more before the market stabilizes. On the other hand, the private investors I talk to believe the market may have bottomed already, or it's at least close enough for deals to make sense. Of course, whether the market's
So let's just stop there.
Yeah.
So, looking at institutional capital, at least in John Chang's opinion, Marcus and Millichap, that, a lot of institutional buyers still looking for some declines in the market, but private buyers, smaller, more middle market groups saying, I think now's the time. And whether and this is more of our opinion is, we don't know, but, we're plus or minus 5% from the bottom. We could be 5% past, we could still have 5% to go, we could be right at the bottom. But we're kind of in a range of where we're getting back into the market.
If 6 p.m. is the market bottom, 5% is like 5:42 p.m.
It's not that big. It's not
that big.
It's not huge. And then,
but I also
if the market's going to come back up, if it's declined 25%, and if you assume that will recover at some point, you've got kind of 20% of growth locked in. Sort of.
And what I think is worth noting too is like, what are these? Yes, sure, private investors could be motivated a little bit by confidence, but also maybe by the awareness that once the institutional investors come around, they can act pretty quick. I don't know if it's committees or whatever, but they have the resources to go and just gobble this up. And it is worth using the advantage that you have, maybe of making these quick decisions and speculating, maybe not speculating, but projecting. They
have the dry powder once they get the mandate. Thumbs up. It's off
at the bottom already will depend on the specific property type, its location, etc. In addition, a lot of the larger private investors are trying to put deals under contract before the institutions fully re-engage. They prefer not to compete with the deeper institutional pockets. So private investors are testing the market while many institutions remain more cautious, potentially awaiting distress. But as I've shared in the past, aside from office properties, distress remains low. The CMBS delinquency rate for commercial real estate as a whole is just 5.1%, about half the levels seen in the financial crisis and during the pandemic. Looking at specific property types, the industrial CMBS delinquency rate is just 0.4%, while apartment delinquencies are a still low 1.3%. Retail CMBS delinquency rates have been trending lower, now standing at 5.9%, and hotel delinquencies have been relatively stable around 6%. Of course, the one property type showing a pronounced upward trend is office, which now has a delinquency rate of 7.4%. But we are starting to see a little more distressed asset pressure, and more sellers are coming to terms with current pricing standards.
There you go.
What I mean by that is we're seeing more sellers price assets to fully engage the market rather than holding out for premium pricing.
That's what I like to do. When I'm pricing, I like to hold off. You want to engage with your buyer, right?
You'd like to if you want to transact. I mean, if you're just trying to, that's the thing. There are some buyers who don't have to sell, but they wouldn't mind selling, and they're like, let's put it out there.
It does seem like for the past 2 years, it was like, you're not going to make any friends with those prices. No one's going to talk to you. Finally, they're talking, it does seem like.
And I think in brokers now, it's interesting. It's like the exact opposite of, when we were in the middle of the pandemic, of where, where in terms of the divergence from like the whisper pricing that a broker would give. Very rarely in these large commercial assets, multifamilies, is it priced at here, $45 million. I mean, does that happen? Like, absolutely. It used to happen a lot more. Usually unpriced, but there's a whisper. They're like, they're looking for $45 million. But, during 2021, pricing had been elevated, but everything was going for 10 to 15% above the whisper price. And it was just insane. You just didn't know how it was going to go. And you had to come in like, where again, before the pandemic, your offer would be below the whisper. Makes sense. And the deals would trade off at or just around the whisper, like very close. But then you'd have to put an offer in above the whisper to even be competitive, or at least at the whisper. So you're starting behind. And now we're at a place where no one's really sure, and so the broker's like, just put an offer in, and it often is 10 to 15% or even more below the whisper, or they'll throw a price out, and we're like, look, we're $10 million below that, and they get so much of the similar feedback of like, we're so far below of where that makes sense. Because I think buyers are a little more confident that like, we're not gonna fall for that anymore. Like, and we're not drinking. Not drinking the potion, just anymore. And unless there's somebody that's very aggressive or has a 1031, the brokers are much more open. And they're having to come back and be like, just put a number in. Not going to be offensive. Like, there's no offensive low. I mean, I guess there is. The only time where they start feeling it is if you offer a price that is below the seller paid for it. But it is what it is. It's like, this is the price. Looks like they overpaid. Because you'll hear the brokers will push it back, be like, well, it has to be above this, because they paid, they paid 43 for it, so like they got to get at least 45, and it's like, well, it sounds like they overpaid. This is the price. Is the price.
I was thinking about that right now, and maybe whether we're at 8 minutes till 6 o'clock at the bottom or whatever, or what, however you slice it. But I was also thinking about where we are in relation to the peak as well, because prices were much higher, and this is just the end of a long gradual decline. It hasn't really felt like a huge decline because there's been such low activity in the market, but prices have depreciated 20 to 30% from their peak already.
I think exactly right. I think that, we're waiting for this next big shoe to drop, and it's like, the shoe's dropped, and like, do we have some more room around the margins? But I'm more in the camp that we're kind of at the bottom, or pretty damn close, where it's hard to differentiate. Every property's a little bit different. We're definitely in that zone. And typically, like, the articles about distress in the markets, like taking a downturn, often come in a period when the recovery is actually taking place.
Exactly.
There's definitely a delay.
And also, the recovery may not get back to that 20%. We may have the reaction back to maybe 10 or whatever.
Yeah, it takes time. Yeah.
But things take time, and
but I mean, it took less than 18 months to go down 25-30%. So I mean, I think a year or two also makes sense. You want to listen to the rest of Mr. Chang? You want to move on?
We can move on because we really covered the thrust of the argument, and I do think that as I was listening to the closed captions were on last night as I was listening to this video, and it ended with uplifting music, and I think there is a little bit of, despite the pressures that now sellers are facing, I think there's something uplifting about these perceptions, and that's how I know that they're spinning it in Marcus and Miller chat, but their spin resonates with what I'm feeling too.
That's good.
But not the feeling in the home buyer's market.
No, not at all. New survey from Fannie Mae is indicating, citing unaffordability, 86% of consumers say it's a bad time to buy a house. Maybe you could say the consumer doesn't know a whole lot about nothing, but it matters. Doesn't matter if they're right or wrong. It's how they feel. Who's going to say you're wrong? Your feelings are wrong. I have a conversation with my 6-year-old about that all the time.
Who knows, what the reasons behind, if people knew the reasons behind feelings, it'd be a little bit simpler. But there is a collection of forces, not the least of which is just the price increases that have happened in the past 4 years that continue to make it feel horrible for buyers to get a home. Now we've got the interest rates there. Again, they're looking for prices to decrease. That's one thing that the home prices have never done. And the unspoken thing in this whole as I was reading this was like, well, man, apartment rents have gone down. Have the feeling is there a renter sentiment? My guess is that renter sentiment is not much better than home buyer sentiment. And I'd love to know how that intersects.
I've just, no, it is a good time to rent. I mean, this is anecdotal, but I've heard more people say, I think it's driven by a lack of a choice, but just the acknowledgement of like, no, I'm renting. Yeah. Like, I think renting makes a lot of sense. And again, I mean, I think about it more frequently than I would admit to my wife that like sometimes renting sounds really appealing. Yeah. Like we own our house and we're in the middle of, we're finishing up like this renovation. Oh, man, you just spend so much money on the house. It's expensive and you're spending all this time with it. And wouldn't you just rather just not have to deal with it and just rent something? And if you want to move, you can easily move. Man, it seems really, really nice. And so I think that there's like part of people are like, you know what? I had this idea of buying a home, but I just don't think that's in the cards right now. Like it's going to put me in a tough financial spot. And if I think about buying, getting strapped down with a house in a 7-8% mortgage versus like I'm just gonna rent someplace nice and I'm gonna drop that $50,000 that I had for a down payment or $100,000 or whatever it is. Like I'm gonna put that into the stock market. I'm going to put it into real estate. I'm going to
multifamily investment.
Yeah, well, they may or may not be accredited, but probably not accredited, man.
Okay,
it's individual. But yeah, but looking at I've got this nest egg, and let me be smart about my investment in allocating capital. Yeah, and I think that's a good thing for like the general economy is like a little bit smarter way that we're going to maybe individuals could allocate capital, because I think probably putting into the I don't like everyone going into like the same index of the S&P 500 because that's probably an over allocation of those 500 companies. But some broader investment into the general U.S. or global economy, or going niche if you're sophisticated enough into a real estate syndication, or invest in a REIT or whatever.
May make you feel a little bit better.
It might make you feel a little better. It'll make you feel like you're a little bit more in control. Not that you've got a little bit of control over your house, but like, man, you got a lot of concentration in that address. I'd rather just kind of separate the two. Yeah. But I think that the longer that this goes on, the more individuals will be in the camp of renting for longer or forever, because they're going to be like, I'm not even thinking of buying a home anymore. Yeah. I haven't gone on Zillow in a year now because it's like, I did the mortgage calculator and it's not penciling. Doesn't make sense. And then you get discouraged. And at the same time, there's probably some decent deals out there on rentals. Yeah,
what you said there, the mobility and the kind of freedom, whether it's freeing your money from being locked up in a house, or really just freeing yourself and being able to move places, or make these decisions that maybe you couldn't have made otherwise. You're not locked down. You don't have to renovate your house if you want to, upsize to another apartment.
My sister-in-law and has a boyfriend who owns a house, and they were thinking about selling. He's been selling his house and moving into an apartment. Yeah, well, for the flexibility, because like she's in medical school and he's in law school, and they're just not sure. They want the flexibility. Yeah, and
that's what
fascinating.
And
He could buy another house, or he could just stay in his house. I think he's got a decently low interest rate.
And maybe the strongest connection would be between single family rentals and home buyers, and maybe that's what we'll see as an increase in single family rentals, because it's kind of a life. You've got your apartment life stage, then maybe you have kids and you want a yard, you want a house, you want your kids to be able to yell and scream at night without bothering the neighbors next door. And I think that the expansion of single family rental space is going to be pretty interesting to follow, and it may not translate as much to apartments, except for when housing demand goes up, everything's going to go up. And despite the bad feelings that we have in the housing market, everyone feels so bad. Home prices have still gone up. Housing demand is still there. Doesn't really matter what you're saying, because your money is actually saying the other thing.
Yeah, it comes back to in the Cushman article, it's like this uncomfortable soft landing. But I think that the uncomfortable is stressed more than the soft landing.
Yeah.
Of like, we made a soft landing. It may make you a little uncomfortable because it feels weird of how we got here, but it's a lot better than us crashing, head first, nose diving into the freaking runway.
Yeah.
And the economy, burning.
Yeah,
it's
agree.
like, oh, this is a little uncomfortable. This is unfamiliar. Well, welcome to 2024.
Yep.
Like,
I agree. So that's a good nice way to punctuate that.
Well, okay. If you enjoyed this episode of The Great Report, make sure you subscribe to the Great Capital YouTube channel. Give a comment on this video and a like. It would be greatly appreciated. Means a lot to Matt and I. And again, if you are a accredited investor, hop on over to solanaindy.com. It's sort of the latest investment offering from Great Capital. Really exciting project in Indianapolis. We'd love to have a conversation with you, see if it's the right fit for you. Check it out, solanaindy.com, and don't forget to subscribe, and we'll catch you next week on The Great Report.